Jonathan, you say it's absolutely not time to sell, right? There's lots more room to run here.
There is lots of room to run, and the key is that this year's run, just like last year's, is not driven solely by speculation. This is great economics, great earnings, great fundamentals. The inflationary risk, which ultimately is what causes the Fed to kill these cycles, has not shown up. So, yeah, I think that we're going to see this going well through 2018. Maybe not at the pace we've seen in the first 3 weeks of January, but I think the up market's going to continue.
Talk to me about this GDP report, because you think the market has it all wrong.
Yeah, you know, GDP is kind of a funky thing in the way it's measured, which is if the U.S. economy is really good and you and I are confident, we not only buy things that are manufactured in the U.S., but we then buy things that are manufactured elsewhere around the world. And that actually is calculated. If we buy foreign goods, it's measured as negative GDP. And so the fact that imports, right, are a drag, but in reality, they're very good for corporate profits.
Well, they're only a drag if exports aren't bigger.
But let's assume that both go up, or that the U.S. goes up, but foreign goes up even more. That means the global economy is growing, but the way that we measure that in the U.S. measures it as a drag. So we have to be very careful to not, to read this properly, which is this is a report about strength. The second thing is inventories were drawn down. So what happens is that stores had more people going in than they wanted, or a business. Those inventories came down, and that's measured as a drag. But what do you think happens next quarter? Those inventories need to get replenished, and then you get a burst in the next quarter to replenish that drawdown. And so, again, that's a positive that reported in the numbers as a negative. But if you're analyzing companies, it's absolutely good news.